Hi, I'm David Scranton, and thank you for watching this video as we talk today about this all-important topic about investing for income. Is it a good time or is it a bad time to make that change in focus from a growth-minded investment strategy to an income-based strategy? And of course, I wanted to pull out the top guns with this because it's such an important topic. So now we're going to bring in, of course, my good friend, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff, investing for income, a conversation that's near and dear not just to my heart, but to your heart too, of course.
It really is. I think there's some tremendous opportunities for people to transition from the appreciation or risk-on mindset into the income scenarios, Dave, and building income versus hoping for appreciation is really going to be a great theme going forward for individual investors. That's really the transition they need to make in this kind of environment because it's very uncomfortable right now.
Well, let's start with the basics though. When you talk to somebody at first about investing for income, what are some of the misconceptions they might have going into that conversation that you need to clear up?
Well, the biggest misconception, Dave, is they're used to an S&P dividend of 1.8% or a Dow dividend of 2.1%. They had no idea they could get double or triple those numbers in this environment with more safety versus investing in the S&P or the Dow.
Yeah, so people's advisors are telling them, hey, all you can get is 1 or 2%. That's the best you can do. And you have to explain to them, no, it's not too good to be true, but you can get a much higher rate of income than that.
That is exactly correct. And with the forecast, Dave, going forward for the major market indexes by the largest Wall Street firms, from Morgan Stanley to Vanguard, are projecting a 2 to 4% return in the major market indexes like the S&P and Dow for the next 10 years. Well, guess what? The income model that we've designed, that you've designed, gets more than that over that time frame just from interest alone. And so now is a great time to transition into those areas with your money.
Yeah, and if they're talking 2 to 4% return, right now, 1.4 of that comes from dividend. So that means there's really not a lot of growth left in the markets, according to these so-called experts. Of course, nobody has a crystal ball. We'll have to see. But you just made an interesting statement. You said it's a really good time now, or maybe those weren't the exact words, but it's a good time, maybe a better time to invest for income. Why?
Well, it's a great time now because yields and rates of interest earnings have gone up and prices have come down, which means that we're presently at about a 2018-2017 pricing model for entry points into investments that are designed to produce income through fixed income assets. And so it's a great buying opportunity for the individual investors at this stage of the cycle.
Yeah, the 10-year government bond, which is what everybody bases this off of, right, was well less than 1% for a while in the middle of the beginning of the pandemic. And now, of course, it's over 2%. And the Fed hasn't even started raising short-term rates yet. So it's gone up that much just on anticipation of the Fed raising rates. And I have to look at it and say, now this whole Russian-Ukraine thing and additional inflation because of the fuel prices and everything, which is part of that, is the Fed really going to be able to raise rates as much as they were threatening? Or, like you say, are we at a pretty good higher level right now with interest rates?
Well, in a lot of ways, our leadership, since you're mentioning Russia's out to lunch, and I think the Fed is having lunch with our leadership right now, and they're all out to lunch. I don't think the Fed knows what to do about inflation other than one thing, and that is to raise rates. And in any environment like this where there's rapid inflation, they've risen rates to crucify or stop inflation in its tracks. They've caused a recession. And so that's why the markets are so volatile at this stage. That's the very reason why the markets are where they are today, with the exclamation point being the geopolitical issues and the potential for a deglobalization in the economy of the globe.
Yeah, and I mean, to make it really simple, like we said on a previous show, Warren Buffett said that when you raise interest rates, the value of all financial assets generally goes down, because I think people need to think of it as a fraction, where in the bottom of the fraction, the denominator, is where the interest rates are. So when you raise the denominator, the whole fraction becomes worth less. And that's true for bonds, that's true for stocks, that's true for rental property, and that's true for, again, most financial assets, right?
It's very true. And we see a lot of confusion in that area, Dave, is with folks that have bond mutual funds or a balanced fund with half bonds, half stocks. And they're seeing assets decay for no reason, especially in the bond side. So if you've got a bond mutual fund, you're better off owning the investments in the bond directly than you are buying the bond fund, because that portfolio manager is going to turn over those assets to buy higher rates as rates go up and pass that loss on to you as the investor. And so anybody that's got bond mutual funds needs to see an advisor and help them transition now.
Yeah, bond funds are a real problem right now. But then again, so are stocks that don't pay a high dividend. I know you mentioned before the ability to get double or triple the income compared to the market. What a lot of people don't realize is even in a common stock strategy, like we utilize, you can have triple the dividend yield and still get competitive rates of growth, at least potentially, in the stock market itself. And right now, with interest rates having gone up recently, it's all those non-dividend or low dividend growth stocks that have taken the biggest hit, almost like bond mutual funds, whereas the higher dividend stocks have done better since the first of the year. And that's mathematical too. I mean, that can be expected, and that's exactly what's happening.
Well, that speaks to the income story. You know, like the portfolios we design are very high performing dividend rates of greater than 4%. So the market doesn't have to have very much momentum going forward. But the reason those companies are losing in value, and even though they're not paying a dividend, is because their multiples and their bottom line gets affected when the cost of money goes up. And so the market's pricing that in right now. So if you're hoping for those growth stocks to skyrocket back, I got a big disappointment for you. The next 12 to 24 months is going to continue to be brutal on them.
And for you watching this, I encourage you to think of it in a simple way. Think of it as real estate. If you were flipping properties, you'd be investing in real estate for the G, for growth, with no potential for income. And if things started to turn in the markets, you'd want to unload that property really quickly, and you'd have to probably ask a very low price just to dump it because you're upside down in it. But imagine instead you had a rental property where you're getting good rental income from good creditworthy tenants. Now if the real estate market started to drop, you probably wouldn't want to sell it at all because it's cash flow positive. You're getting cash flow given to you. So yeah, maybe on paper that rental property's dropped in value, but it's dropped less than that property that you were flipping. And that's the same is true. And that's why, again, these stocks that don't pay a dividend are taking a much bigger hit in this environment, whereas those that are paying a dividend are taking a much smaller hit. And bottom line is you have more staying power because you're getting that bird in the hand. You're getting that income payment. So
that's all great, Dave, but you forgot one thing in all of this mess. In this environment, and because there's a lack of leadership, I have decided to run for Congress in 2024. I'm not joking.
Congress here in Florida. Okay. All right. So our Texas viewers, here I come. Dave Scranton is moving to Texas. I feel safer in Texas now politically than I do in Florida. So thanks for the heads up, Jeff. I'll get my house for sale right away.
Okay, you'll see. I'm going to prove you wrong. Just because you made fun of it, I'm going to prove you wrong.
I love it. I love it. There you go. You heard it right here on The Income Generation. Jeff Small for Congress.
That's right.
All right, Jeff.
It's coming.
It's been my pleasure as usual. You never stop surprising me with the crazy stuff that comes out of your mouth. At least when you're talking about finance, you make a lot of sense. That's good. Jeff Small, thanks a lot. I appreciate your time today.
All right, Dave. Thank you, buddy.
Thank you for watching today's video, The Income Formula, How and Why It Works. If you enjoyed this video, click the thumbs up button to give us a like, and make sure that you subscribe to our YouTube channel for new content each and every week.